Hello, dear algorithms traders. In today's article, we will be looking at the highly qualified statements of the trading coaches about the extent to which a footprint chart can actually help us in trading. This message from the coaches is aimed specifically at retail traders who have only worked with candles in the foreign exchange market so far. I would even agree with the statement that you can look deep into the candle with a footprint chart, because you can actually see the volume traded on the ask and bid side. The crucial question is whether this information actually helps us. If the trading coaches supposedly know exactly where the big players are getting in or out, they would be able to trade all the ups and downs in every asset in such a way that they would end up not knowing what to do with all that money. Why should you then still give seminars for a pittance? The truth is that they don't make any money from their trading, and in order to at least make ends meet, they have to pretend to be successful on the outside. And then you post the crucial wisdom for a beginner. Here we can see how the price is moving up sharply, and take a look at the top candle. The volume looks like a P. The P stands for power and means that the price is making another small pullback before moving properly up. Here we see the small pullback and then the strong upward movement. Oops, something seems to have gone wrong. Well, the positive and negative delta show us where the price is heading in the future. A negative delta occurs when the price is moving down, and a positive delta when the price is moving up. We see a strong bullish candle with a positive delta. The next candle is also bullish, but with a negative delta. Here too, the delta is negative and the price could now move down. Oops, well, that can happen. So, now it's going down. The delta is still negative. Too bad, wrong again. So, now it could work, it's sure to go down soon. You just have to move the stop a bit and give the price some breathing room. Now it looks good, the delta is negative. Well, unfortunately, bad luck. The strong bullish candle has a negative delta, so it's now going down. It's almost time, you have to be patient, a lot of patience. So, here we go short, the breakout is sure to come soon. Yes, it's only a small pullback, we have to hold on. So, here we go, we buy again. Yes, unfortunately that was a bad move. You can't always win. Let's look at a few footprint sayings. We see a strong bearish candle with a positive delta, and after that the price goes up, as experience shows. We want to check that out. We see a bearish candle with a positive delta, the price goes down further against expectations, then up a bit and then down further. Basically a typical equilibrium. The next bearish candle with a positive delta. Unfortunately the price goes down, and as soon as you are stopped out, it goes up again. The same thing again, you get stopped out and you lose out again. It almost worked here. This situation also looked good, but unfortunately not in the end. We want to test whether you can actually see where the big players are getting in and out with a footprint. The footprint charts were developed in 2002 at the CME and have been available to the public since 2003. In principle, the footprint charts are still relatively new compared to other charts and were only developed with the introduction of electronic trading. This made it possible to bundle the data and then visualize it. Here we see 5 footprint charts in the M1 and here the summary in the M5. To do this, the volume is simply added on the ask and bid sides. In the M1, the highest ask volume was at the upper price level. In the M5, however, the highest ask volume is 2 price levels lower. It is therefore difficult to identify specific absorption at different price levels. In the footprint chart, we see the market sell orders on the left bid side, which is the seller side. On the right ask side we see the market buy orders, i.e. the buyer side. The orders on the bid side generally go down, the orders on the ask side go up. In the market, there is, on the one hand, liquidity consisting of limit sell and limit buy orders, and volume consisting of market sell and market buy orders. The market sell order basically runs into the limit buy order and the market buy order into the limit sell order. In between are the price and the spread. Market orders move the market, while limit orders can hold the market up. But which orders are stronger? The market or the limit orders? Let's compare this to a burnout, where the front wheel is braked, the rear wheel spins, but the machine does not move forward a millimeter. So, when an infinite number of market orders meet an infinite number of limit orders, the market orders are held up. This means that the limit orders are significantly stronger than the market orders. We know that the big players collect their contracts within an equilibrium, and how do the big players enter or exit their position? Well, first and foremost with limit orders, and that's because iceberg orders only work via limit orders. In addition, synthetic iceberg orders are fundamentally unknowable, and the big players can use them to conceal their actions. On the bid side, this 22-lot market sell order runs into a 22-lot limit buy order. And on the ask side, these 38-lot market buy orders run into a 38-lot limit sell order. Here we see a possible absorption of the market sell orders, which are being held up by limit buy orders. The price should now be moving up, but the opposite is the case. Again, a possible absorption occurs, but the price continues to move down. This means that a specific absorption cannot be reliably identified. In the footprint chart we see 277 lots on the buyer side and 717 lots on the seller side, so we have a strong negative delta. But trying to use this to clearly determine where the price will go next is absolute nonsense. A price imbalance is always calculated diagonally from bottom left to top right. This looks to see whether the sellers are, for example, 300% stronger than the buyers. The diagonal view is taken because the best ask price is always higher than the best bid price. Unfortunately, many coaches forget that the spread in the market is variable. The red bars show the spread within a downward movement and the green bars the spread within an upward movement. I ran this analysis over several days and found that the spread was larger than one tick in 42% of cases. This means that in 58% of cases the calculation of the imbalance is correct, but in 42% of cases it is not. And this is exactly why the imbalance works like a blinker. Sometimes it works, and sometimes it doesn't. But I wouldn't use this as a trading strategy. If a footprint chart is moving sharply upwards, it is said to be a strong buyer, and if the price is moving sharply downwards, it is said to be a strong seller. If the price is in an equilibrium, you are told that the market participants agree. That is the biggest bullshit I have ever heard, by the way. We see an equilibrium here, but there is no agreement here because the big players are currently collecting the dollar. First, the price is pushed down. This brings short traders into the market. The big players push the price up, which stops out the short traders. The stops now trigger market buy orders, which in turn are taken up by the big players' limit sell orders. The price is pushed down again, and the short traders are brought out again. The strong movement was not caused by a strong buyer, but by short traders who were stopped out. Of course, the big players initiate this process, but they invest little money. And so it goes on until they have collected enough and drive the price down. So much for the topic of unity within an equilibrium. We have already seen that a strong upward movement is usually triggered by stops by short traders. And the downward movements are mainly financed by the long traders who have been stopped out. This is because the big players are entrepreneurs. Let's look at an example. A big player collects 2,000 lots within an equilibrium and pushes the price up using stops. He has now reached 20 ticks, and if a tick is worth, say, $10, he has earned $400,000. Another big player also invests 2,000 lots, but he simply pushes the price up and collects 100 lots at each level. Of course, the profit gets smaller the higher the price goes, although the value of a tick always stays the same. In the end, this big player has only earned half because he only bought at an average price. So, it makes no sense to simply push a price up and buy because that would be far too expensive. A strong price up or down has nothing to do with a strong buyer or seller, but rather with stopped out sellers or stopped out buyers. The big players use the retailers' stops to achieve their goals cost effectively, and unfortunately this cannot be read in a footprint chat. It is therefore a false assumption that the left side represents the seller side and the right side the buyer side. The big players enter and exit with synthetic iceberg orders, and the retail traders are stopped out to move the market up or down. If the market goes up, short traders are eliminated. If the market goes down, the long traders are in, and within an equilibrium, long or short traders are attracted and stopped out. On the left are the long stops, i.e. the buyers who were on the wrong side. On the right are the short stops, i.e. this time the sellers, who were also on the wrong side. In addition, the ask and bid sides have nothing to do with each other, since buyers and sellers conduct their business on the bid side and the same on the ask side. In principle, we have two independent elevator shafts, with the left elevator only going down, the right one only going up, and the driver's cabin in between. If we now transfer the whole thing to the DOM, the cause of the price movement only depends on the market orders that run into the limit order. The result is at the end of the footprint chart. And you can only make a clear deduction from a cause, not from a result. With a market sell order you can sell the euro or buy the dollar. With a limit buy you can buy the euro or sell the dollar. We now see the footprint chart and know that 168 lot market sell orders ran into 168 lot limit buy orders. Now let a trading coach explain to you exactly what just happened. And because it was so nice, here's the whole thing again for the ask side. The fact is that the market sell and market buy orders never meet in the market and completed purchases and sales take place on each side. If a trading coach tells you a fairy tale again soon, you will know for sure that he has no idea. The only solution is to find out how many stopped out orders from retailers were taken up by the limit orders of the big players. And how many irrelevant markets orders the other market participants received. So, there are two crucial questions. Of the incoming market sell orders, how much does the big player take and does he use it to get in or out? For this purpose, I have programmed a special chart over the last few years to analyze the entries and exits of the big players. In the equilibrium we see a euro purchase and then the price goes up. The euro continues to be bought and as expected the price goes up. In my video, Volume Follows Liquidity, I was able to show that you can already predict where the volume is going based on liquidity. My created chart, the basic knowledge of how the big players operate and different programming helped me to identify the algorithms. Of course, this is not a holy grail either, but it has enabled me to significantly increase my efficiency in recent years. A footprint chart only shows the past that has been processed and thus a result that the trading coaches use to make a fortune. Of course, you can look deeper into a candle, but the bottom line is that it is just as efficient as looking at the volume, working with indicators or looking at the candles. The market orders move the market, but the limit orders ultimately determine where the market is going. And that is precisely why the future belongs to the liquidity traders. I wish you the serenity to accept the things you cannot change, the courage to change the things you can, and the wisdom to distinguish one from the other. I wish you much success. Best wishes, Michael.